Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
We're going to turn our attention to taxes. It's a hot topic, especially coming out of election season. And we're going to talk about what that means for your clients and for your consumers. So we're going to talk a little bit about budgeting, which I know is everybody's favorite topic, whether we want to do it or not.
In this episode, I'm going to talk about when to leave your 401k with your former employer.
Today, Ryan and I are going to talk about the people who don't run out of money in retirement.
And now for our weekly question and answer segment.
And welcome back to Financially Speaking. I'm here today with Ryan and Logan from Buska Wealth Management and Buska Retirement Solutions. We're going to be answering some of your questions today, but if you would like to see a question answered on a future segment, please email us at info@retirewithbuska.com. Thank you both for joining me today.
Thanks for having us.
We're going to turn our attention to taxes. It's a hot topic, especially coming out of election season. And we're going to talk about what that means for your clients and for your consumers. So Logan, I'm going to start with you. What are some of the most common tax mistakes we're seeing from customers these days?
Yeah, so a lot of the times what we see is how people are saving their money when it comes to those retirement accounts. So when you're putting money into a 401k or any type of employer-sponsored plan, most of the time we've been told to put it into the pre-tax side. Well, it can make sense to also go into the Roth side depending on those income taxes for that year, but then also thinking about taxes down the road, whether it's for legacy planning or for using that money to avoid RMDs. So a lot of the times the tax strategies or tax things we see that our clients are making mistakes on is how the money's going into what type of accounts.
I hear that people say a lot, I'm looking for that instant gratification of the tax relief now, but not thinking about the taxes in the future, is what I'm hearing you say.
Yep.
So Ryan, thinking about the future taxation, how concerned should our viewers be about the tax cuts that are getting ready to expire in 2026?
Absolutely. The concern is valid, but it's really outside of our control. So what we need to do is just plan for those events. Things like Logan was talking about, those Roth conversions, putting money into Roth right now, saving yourself those taxes in this moment, help you in the future. So you just want to plan ahead as opposed to being worried. That doesn't really do anyone any good.
So having a plan to prepare for rising taxes is what I'm hearing, but what can they do as part of that plan to prepare?
Sure. So one thing we're really focused on right now for those that it makes sense for are Roth conversions. So taking money that you haven't paid taxes on and would pay taxes on in the future and paying those taxes now, putting that into your Roth accounts and letting that grow tax deferred and tax free at this point as opposed to waiting for the future and seeing what those taxes are then. That's a big one. Otherwise, if you're still currently working, putting that money into the Roth right now and you're paying those lower taxes as well is a good way to avoid or kind of plan ahead, so to speak.
So Ryan, speaking of working, we've talked a lot about taxes applying to the individual who's working and trying to prepare. But Logan, let's talk a little bit about that trend we're seeing where people are becoming small business owners, and you have to think about that differently. What are some of the tax implications for starting a small business?
Yeah, we're seeing it more than ever where people are doing those side hustles or get a second part-time job to help to pay for the expenses with the rising prices of goods and services and all that. So when it comes to establishing a side hustle, it really starts with what type of business you're starting. If it's a sole proprietorship or an LLC or any of the other types of business setups, what comes with that is some different taxes. On the individual side, it's pretty straightforward. We get our tax documents in January, we go to the accountant and just have to have it done usually before April 15th or whatever that tax date is. With businesses, there's going to be more taxes that come along with it, whether it's paying taxes for your employees, or if you're just a self-employed individual running your own business, well, then you have a self-employment tax. So there's all these new taxes when it comes to starting your business. And then you also really want to be focused on how you're paying those taxes. For some people that are running those small businesses, it could make sense to file those taxes quarterly and pay in quarterly versus doing it just once a year like we do for our individual side. So I just highly recommend before you start that business is to sit down with a professional that can help you walk through what's going on and what your plan is for that business.
Well, thank you both for joining me today. Unfortunately, that's all the time we have. And thank you all for joining us. We'll be back with more right after this.
The Tax Cuts and Jobs Act of 2017 reduced income taxes for many American households, but many of those provisions will expire on December 31, 2025 if Congress doesn't act. That could mean that you'll pay higher taxes, but you can take more control of your retirement by prepaying some of those taxes now at the current rate. Call us at 715-355-4445 or visit retirewithbuska.com for more information.
Welcome back to Financially Speaking. Today I'm here with Kaylee and Ryan from Buska Wealth Management and Buska Retirement Solutions. We're going to be answering some of your questions about preparing for retirement, but if you'd like to see us answer a question on a future segment, just go ahead and email us at info@retirewithbuska.com. Kaylee, Ryan, thank you so much for joining me today.
Absolutely.
So we're going to talk a little bit about budgeting, which I know is everybody's favorite topic, whether we want to do it or not. Ryan, I'm going to start with you. How can folks effectively balance their income with their lifestyle?
Sure. I think one of the most important steps is just knowing where your money goes. Right now with credit cards, debit cards, things like that, it's not like it used to be with checkbooks where everyone really balanced it out. So some people really don't even know what their monthly expenses are compared to their income. Everyone knows what they're making, right? So everyone looks at their paycheck. Not everyone looks at those expenses in the same way. That's an important first step. The next step is making sure you don't put yourself in too much debt that your income's not covering it. So buying that house that's maybe a little bit more than you need, or a car that's a little bit more than you need, looking at those and then not getting yourself in a point where you can't get out of debt either.
So those auto pay subscriptions are getting us all in trouble is what you're saying?
Yes, absolutely, to some degree.
To some degree. Kaylee, what are the most common budgeting mistakes that you are seeing clients make?
Well, to tailor off of what Ryan said, not knowing your budget, I think, is number one, and also being too lax or not strict enough with your budget, or honestly realistic. So I know when we meet with clients, one of the things that we do is we have them fill out a budget sheet when we're intaking all the data with them. And so that can be a pretty eye-opening experience for some clients, good or bad. But again, I think just letting them know where the money is going in and out. And then another thing would be like adjusting your budget for your needs. Like our needs change throughout our lifetime. So make sure that you are assessing it every 6 months or annually at least, because maybe you had a child and you want to start a college savings program for them, or maybe you paid off a big expense and so you can, put that towards something else at that point, or you got a raise. We adjust as our life changes and your budget needs to adjust as well.
And speaking of budget, Ryan, one of the things that often comes up is those unexpected expenses or even accumulating too much debt, right? So what would you recommend to our audience for how to prepare for that?
Sure. So going back to the first step, right, is making sure you know what your budget is the baseline, and then giving yourself that safety net. So making sure that your budget is in line with, you're not living paycheck to paycheck if you can avoid it at all. Obviously, everyone's circumstances are different. We understand that, but just really looking at the overall and making sure that you're building yourself up for success in the future.
What strategies, if we're going to talk about being prepared, we're going to talk about budgeting, living within your means, all of the things that you guys have said today, we got to track that. So Kaylee, what strategies do you recommend for tracking income and expenses?
I think it depends on your own individual needs and what you like to do. So if you want to be old school, you can, have a paper budget that you track. Otherwise, maybe an ongoing Excel spreadsheet. Otherwise, if you are, into technology, there are so many apps these days that can, track the inflow and outflow of your cash. Some of them can get pretty detailed and let you know all those subscriptions that you are signed up for. Otherwise, every transaction that you make, and also just track every transaction and your spending trends, which is pretty great to see, and sometimes good, sometimes bad, but enlightening at least, right?
I think I'd be a little surprised if I signed up for one of those today. Well, thank you both very much. I think we could talk about this forever, but that's all the time that we have for today. And thank you all for joining us. We'll be back with more right after this.
Are you looking for someone to help make retirement planning a little easier? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our three companies, there's a lot we can do to make your retirement planning process less stressful. By creating a holistic retirement plan that incorporates investment management, income planning, tax planning, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Logan Waller from Buska Retirement Solutions and Buska Wealth Management. In this episode, I'm going to talk about when to leave your 401k with your former employer. While rollovers are common, there are times when leaving your retirement account with your former employer may make sense. An article from MassMutual titled 3 Times When Leaving Your 401k with a Former Employer May Be Smart provides some really excellent insights. First, let's talk about what your options are when you change jobs. When you leave your job, you can roll over your 401k into an individual retirement account or an IRA. If you elect this option, you may experience a larger array of investment options, which means you can do more to customize your portfolio allocation. However, remember that you may owe income taxes on the balance when you roll it over. Secondly, you can roll your 401k into your new employer's 401k if it's allowed. Not all employers offer this option, but if your new employer does, and you like your new job's investment options, you may want to consider this. Plus, it can make things simpler to have your retirement accounts consolidated this way. Your third option is to cash out your 401k. In my opinion, this is inadvisable in most circumstances. If for some reason you really need the money right now, then it may be worth it. But in most cases, you'll just end up paying a penalty that you could easily avoid. Now, let's talk about leaving your 401k where it is. The first reason you may want to consider leaving your 401k behind is the possibility of better investment options and fees. Simply put, if your new job has everything you've ever wanted except a retirement account that provides you with good choices and low fees, why not just leave it where it is? According to the article, fewer options and higher fees are most common when moving from a large company to a smaller company because larger companies often have the assets that give them the negotiating leverage to implement lower portfolio management fees. Another reason to keep your account with your former employer may be the possibility of eventually needing early access to the money in it. If you leave your job during the year you turn 55, you think there's a decent shot you'll need withdrawals from the retirement account prior to turning 59 and a half, it's probably best to leave your money right where it is because of the rule of 55. This rule dictates that if you retire, move on, or are let go during or after the calendar year in which you hit age 55, you're permitted to take withdrawals from your 401k without being slapped with the dreaded 10% early withdrawal penalty. But bear in mind that you'll still owe your ordinary income tax on the money you withdraw. Access to a stable value fund may be another solid reason to leave your account with your former employer. This may be a particularly wise play for those who are close to retirement and want to maintain a fairly conservative asset allocation. This is because many 401ks provide stable value funds that seek to maintain principal via a combination of fixed income securities and insurance company contracts. These insurance-wrapped bond funds, which maintain a stable share price and often provide a competitive yield, aren't available outside of 401ks. Now, bear in mind that there are some possible downsides to leaving your 401k parked with a former employer. The first potential downside is that you won't be able to keep making contributions to your plan once you leave your company. This could possibly diminish your compounded growth because the account will only provide returns based on the balance on your last day with the company. You may also be charged a higher annual maintenance fee as a former employee. Furthermore, you lose the opportunity to borrow from your 401k after you leave. Many employers permit their current employees to take loans of as much as 50% of their 401k balance, up to a maximum of $50,000. Generally, those loans must be paid back within 5 years with interest that eventually goes back to you. Our team recommends tremendous caution when it comes to taking a loan from your 401k because you may have other better options to choose from. But the fact remains that leaving your 401k with your previous employer eliminates this option entirely. If you have questions or concerns about your 401k, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Have you heard the term fiduciary before? According to Investopedia.com, being a fiduciary means being legally bound to put your client's best interest ahead of your own. Did you know that investment advisors have a fiduciary duty to clients, but broker-dealers just have to meet the less stringent suitability standard, which doesn't require putting their client's best interest ahead of their own? At Buska Wealth Management, all of our advisors are fiduciaries to provide our clients more peace of mind. Call us today or go online to schedule your complimentary review. You've worked hard to save money for retirement, but wouldn't you rather thrive and not just survive your golden years? My newly released book, Golden Rules of Finance for the Golden Years, offers key tips for managing your retirement money and ensuring you have a more complete plan to make your retirement dream a reality. Call 715-355-4445 or visit buskabook.com to request your complimentary copy today.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Kaylee Berenson from Buska Retirement Solutions and Buska Wealth Management. Joining me is Ryan Connor. Today, Ryan and I are going to talk about the people who don't run out of money in retirement.
That's right. In a past segment, we talked about people who don't have a lot saved for retirement and are worried they won't have enough. For this segment, we're going to flip the script a little bit and talk about people who set themselves up for success in retirement.
And we're not just talking about super rich people, are we, Ryan?
No, we are not. A CNBC article titled "How to Increase Your Chances of Fully Funding Your Retirement" offers some uplifting news that's not just for the wealthy. The article states that researchers have found 79% of Americans make this one move who won't run out of money in retirement.
I love this article.
Me too.
First, the article mentions that it can be hard to figure out how much money you'll need in retirement. Here's a good place to mention that a financial services professional can help you make that determination.
That's right.
The investing research firm Morningstar took a look at data related to spending, investing, life expectancy, and other factors to determine whether or not people will be successful in retirement.
Now, what did they find out?
Well, Morningstar predicts that 45% of American households will run out of money in retirement. For people who find themselves in that situation, it could mean heading back to work, taking on debt, or finding ways to cut costs.
So far, this doesn't sound any different from the last segment.
Nope, but keep listening. It does get better.
All right.
There's good news for people who are still early on in their retirement journey. Morningstar found that 79% of people who invest in a workplace retirement account and have at least 20 years to save will likely have enough to live on throughout their retirement.
So that's great news, and I hope that comes as a relief to a lot of people out there watching today.
I'm sure it will.
Now, what's another way for people to set themselves up for success in retirement?
Well, Morningstar found that the likelihood of running out of money during retirement goes down the longer you stay in the workforce.
Well, that's not particularly surprising.
Morningstar found that 45% of people who retire at age 65 run out of money during retirement, but only 28% of people who hold out until age 70 suffer that same fate.
That's when you want to think about owning your inner 90-year-old. You may want to retire at 65, but if it means 90-year-old you will face a major financial crisis, you may want to consider staying in the workforce for a few more years.
I completely agree with that, Ryan.
Now let's talk a little bit about why saving in a workplace-sponsored 401k sets people up for success.
Well, for one thing, the money comes out of your paycheck before you even see it, so you don't miss it as much as you would have if you had to transfer it yourself. Plus, once it's in your 401k, you can't really spend it, at least without not incurring penalties.
Now, there are some exceptions to the penalties, but you are right. It's harder to spend the money once it's in that account. And you can just let the money save and add up and earn compounding interest.
Another benefit of saving in a 401k is an employer match. If your employer offers a match at a certain percentage at the amount that you save, that's free money, and that can add up over time.
Don't leave free money on the table.
The bottom line is that if your employer offers you a 401k and you don't participate, you may want to course correct.
Now, what if your employer doesn't offer a workplace-sponsored 401k plan?
Well, you can still save for retirement with an individual retirement account, also known as an IRA. You can make contributions much in the same way that you would a 401k.
Okay, so I'm saving in a 401k and taking advantage of the employer match. How am I benefiting from working longer?
Working longer means that you have more time to save. As we've already discussed, it also means that your money doesn't have to last as long.
So that means a shorter retirement.
Yeah, but a shorter retirement is better than an unfunded one, don't you think?
I think I would have to agree.
Plus, if you wait longer to retire, you may be able to get more from your Social Security. The Social Security Administration will boost your earnings by 8% per year for every year that you wait beyond your full retirement age to claim your benefits.
Waiting to retire until age 70 means you get the highest possible Social Security benefit.
That's right. People who wait until age 70 are able to save more, and they're able to get more from their Social Security benefits. That seems like a recipe for success to me.
Now, it seems that way to me too. But what if someone isn't able to work until age 70? Not everyone can realistically plan on doing that.
Well, even if you can't make it to age 70, delaying past full retirement age can help. Even if you delay it by just 1 year, that additional 8% is still a decent bump. Additionally, working part-time, even if it's just a few hours a week, can help too.
I think what you're saying is that there are always options.
That's right.
I like that, Kaylee. Now let's switch gears a little bit and talk about an article from MoneyWise.
Do you mean the article titled, "The New Standard, More Americans Are Contributing 6% of Their Paycheck to Their 401k. Here's how much it can boost your retirement savings"?
Yes, it's a long title, but a good article.
I thought so too. It starts by pointing out that it used to be common for employees to contribute 2 to 3% to their workforce 401k. But things are shifting and people are contributing more.
That's right. And the article says that many workers are now enrolled in plans that automatically default to saving 6%. In fact, 29% of plans are doing this right now, which is great. It would be great to see that number go up, though.
I agree. 33% of plans with automatic enrollment are enrolling people at 3% still. If those plans bumped people up to 6%, then so many people would enjoy a bigger benefit and a bigger nest egg.
Now, the article also mentions that the median account balance for Americans aged 64 to 74 in 2022 was about $200,000.
That may not go far in retirement. If you withdraw money at a rate of 4% per year over 20 years, that's $8,000 per year.
That's why saving more each year can make a big difference. A bigger nest egg means you have more money to take out each year.
That's right. Let's talk about what the article says about a 6% savings rate. In 2023, the median annual wage in the U.S. was $59,540. If you save 6%, that's about $298 per month. After 35 years, that could potentially add up to $616,000.
That's more than 3 times the median amount.
Right? And that doesn't even count yearly raises or a higher annual return on the investment. The article makes a calculation using an 8% annual return on the investment.
Now, this calculation also doesn't include funds from employer matching. Now, with employer matching and a slightly higher return, that nest egg could be even bigger.
I think people who have plans that automatically enroll them at 6% are in a good starting place. If they're able to add to that and increase that percentage each year, they may experience even greater rewards.
I agree. 6% can be a great place to start, especially for people who aren't sure how much they can afford to save. And I think once people start saving, they often realize that they can save just a little bit more.
Ryan, I like this conversation that we've had today. I know sometimes discussions about the average person's retirement can seem kind of gloomy, so it's nice to identify some rays of hope.
Absolutely, Kaylee, and I think there's always hope if you know where to look.
And on that note, we're out of time. If you'd like to talk about your workplace retirement account and your savings rate, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this. Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope that you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now might be a great time to get a second opinion on your retirement plan. Give us a call at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your own complimentary, no-obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.